Welcome to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in financial markets and the economy for this week and beyond. Today is Tuesday, July 15th. I'm Mike Bernick, and joining us today are Larry Edelson, Doug Davenport, Mike Larson, Don Lusick, Bill Hall, and Mandeep Rai. All right, good morning, everyone, and welcome to the Squawk Call for this Tuesday morning. Obviously, last week we saw a little bit of volatility come back into the markets with a bit of a sell-off early through midweek, and then a rally towards the end of the week. But it was still enough for the worst showing for U.S. stocks since April, which is the last time we had any kind of a meaningful correction of 5-6%. So where do we go from here? That's kind of the topic of discussion. And Larry Edelson, why don't we start with you? I know gold and silver have been kind of volatile lately, both up and down. What's your take, near term and longer term, on the precious metals here?
Well, the pullback was expected. It didn't surprise me at all. I think we'll go a little bit lower in gold, perhaps even get under 1,300. Major support at 1,296, and then we'll rally and then up to about 1,400 in gold. We're in a new bull market, so it's going to have its ups and downs, but overall, it's looking pretty darn good to me. Mining shares are looking fantastic. We've been able to take out some nice profits there lately, and I'm buying more in a dip. So I don't think there's anything out of the ordinary with gold. It's reacting, to a lot of news out there about the Middle East, Israel, and Hamas, and all that stuff. But you can't buy gold every time there's a little nervousness. It's the big picture that counts, which is really the cycles of war are impacting gold on a long-term basis. But trying to trade gold on short-term news is just insane for any market, for that matter. Stocks, I'm looking for one more tiny new high in the S&P, just a little bit higher here. We might get to 2,000, but that's it. That thing is so overextended. The problem I have with the stock market now is that the lack of a pullback. The cycles have been inverting on a short-term basis there. That's why we haven't gotten the pullback. The problem is it's more bearish than bullish. When the correction comes, I think it's going to be pretty nasty. That said, stocks are still in a long-term bull market. Even after a correction, I'm still expecting Dow 30, 31,000, 32,000 over the next 2 to 3 years. But we've got to get a decent correction first. And it's coming soon. I've been wrong 5 times so far this year with it, but it's coming. And that's really it. I mean, dollar's holding its own. Euro's on the edge of a third wave down. Could get a little bounce up in the euro before it really craps out, another bounce up, but it's a pretty sick currency. And the grains are in their final throes of a major meltdown, which should form a major bottom for the grains, a little bit lower. Oil, I'm putting out an issue this Friday for Real Wealth. Like gold, the war cycles are beginning to really impact the oil market. I think the decline that's underway now will probably pretty much be the last decline. Major support at $93, and we're going to head up to about $125 on the first run up. And longer term, it's looking like oil can go to $300.
Wow, that's quite a price target.
Well, not really. Not really. I mean, we can double the old high at 150. Not such a big target, in my opinion, compared to where gold and silver can go. But again, I know you guys think I'm crazy, but the real forces at work here are the cycles of war, and maybe it's a misnomer because it has the word war in it, and it's not just war. It's geopolitical conflict. It's also the decline of the Western governments, Europe and the United States, and all the taxation they're doing, confiscation of money, FACTA, and all that stuff, which is really causing money to move into asset classes in such a way that they're creating massive long-term bull markets, stocks and in the metals, and in commodities. So everything's on my long-term forecast, and I'm very, very comfortable. Short-term's been very, very difficult, as we all know. But that's about it.
Okay, thanks for those insights. Doug Davenport, I know you're a very astute observer of the market's trends. What do you think here in terms of a stock market correction? Do you think it's something to worry about, or was last week's volatility just a blip?
Well, I think that it's a waste of time to really worry about it, even though one has to be prepared for when it happens. But you can go back. We haven't been below the 200-day moving averages. Y'all probably certainly no stranger to this, but we've been below the 200-day moving average since Thanksgiving of 2012, and that's the sixth longest that long. So easily the market is on shaky ground, but I still think that 2025 is where this market may go to before it gets some sort of a pullback, before it gets another final advance sometime in the fall. But, lots of people call for market corrections. You read it all the time in newsletters, and you see people saying the world's coming to an end with the stock market. But you do have, and they think that, well, QE's going to end in October. You got the Portuguese debt problem. You got problems all over the world, like Larry mentioned. I don't think that that's a reason yet to get out of the market, because the trend is still up until it isn't, and we just have to watch the charts to realize when that may happen. But you do find it, I think, in my 35 years in the business, if you look back, it's been extremely rare for the market to ever have any kind of a significant pullback during earnings season. And, of course, there will be some misses as we go into it right now, but we all know how that game is played, that most companies beat estimates, and then they'll raise their forward guidance, and then they'll keep a bottom under the market for a while. And, fortunately, J.P. Morgan, Goldman, and Johnson & Johnson came out and beat estimates this morning, so I was glad to see that before the market opens. But then we also have tech this week. We've got Google, Yahoo, eBay, and Intel coming up this week. Intel's up about 25% so far. Well, lately it's had a nice run. So tech is certainly worth looking at. I noticed that Goldman yesterday called tech the most undervalued sector of the U.S. stock market right now, and it looks like that there are people just waiting for Google and Yahoo and eBay earnings to come out before they go back into those stocks, because StockTwit users are very, very bullish right now on technology stocks. That could be a contrarian indicator, but still they're very, very bullish on those. Back to Goldman, yesterday Goldman called for a comment, for their precious metal analyst called for gold to drop to $10.50 by year end, which I thought was interesting. And even Societe Generale called for $12.45 as the low for gold sometime this fall. But that was a nasty pullback yesterday, but necessary pullback nonetheless, I think, to form a higher low before gold will go back up. Support should be around $1,300 to $1,290 in my estimation. GDX, you look at the miners, it's got a big gap down at $25 a share, and it probably could go back. I'd like to see it go back and fill that gap, and then gold miner shares could really begin to take off. But gold short term, like Larry said, you can't figure out what it may do, because no one would have thought yesterday would have happened. But it's been up nicely in the last month or so it needs to have a pullback so it can have another swing trade to a higher level. And I noticed that gold, I went back on a chart I sent to my clients, or my subscribers this week, talking about gold's inverse relationship with the 10-year yield, and went back and looked at from October of 2012 to June of 2013. Gold dropped from about $1,800 an ounce down to about $1,200 as the Treasury note rose from 10-year note went from 1.7% in October of 12 to 2.7 in June. Very big inverse relationship there. And then gold last fall rose from $1,200 to $1,336 an ounce as the 10-year yield fell from 3% at the beginning of the year to recently at 2.55. So for the last 3 years, it's had an inverse relationship with 10-year Treasury yield. So that's certainly something I look at too to see what is affecting gold. But emerging markets, I still like my Treasuries. I'm still long Treasuries right now. Of course, Yellen talks today, and we'll see what she says, and I doubt she'll be flapping any hawkish wings out there. She'll be still very, very dovish, saying she probably has no idea when they'll ever raise rates. So I think everything still looks okay for the equity market.
All right, Doug, thank you for those insights. Mike Larson, we just left off with Doug on Janet Yellen and her Fed testimony today and tomorrow. Do you expect any fireworks out of that?
Yeah, good morning, everybody. It's interesting that Doug talks about how treasuries have rallied, and since the beginning of the year, that's true. But if you look at bond futures in the last month and a half, to almost 2 months now, they've basically just chopped sideways. Interest rates on the 10-year Treasury note yield hit 2.4% in mid to late May. They're at about 2.56%. So, we made a spike low on the chart, and we've been kind of marking time since then. So I think you can talk about the returns bonds have had, but in the last month and a half, you haven't made anything. And utilities, in addition, the XLU, for example, had a nice topping out and reversal pattern in the last couple of weeks, or last several days, excuse me. So some of the bond-sensitive sectors have started to stall. Bonds themselves have lost a little bit of value. Nothing, nothing crazy, but at the very least, the trend towards lower interest rates and higher bond prices has stalled, albeit we haven't yet seen a full reversal. That's talking about the long bond and long bond prices. If you look at something like the 2-year yield, for example, that actually has continued to rise, even as we've talked about, ongoing QE. If you look at the 2-year yield, for example, I was just putting together a chart. It bottomed out last April-May time frame around 20 basis points. That's all the way up at 46 basis points as of today, and it has had nowhere near the rally of the long bond. So in other words, we've seen the yield spread between short-term instruments and long-term instruments compress quite a bit, 5s to 30s, 2s to 10s, and so on. So the short end of the bond market is saying that don't listen to Yellen, it doesn't matter. They're sniffing out rate hikes. You wouldn't see the 2-year yield at almost a 3 or 4 year high at this point if the bond market wasn't telling you that the Fed is lying to you when it says it's going to continue to keep rates low. So keep in mind that some of these spreads and other indicators in the interest rate markets aren't showing the complacency that the long bond is. So that's kind of my view on the Fed. I think that the economic data is it's not the 1990s style, but we have had 5 months of job growth over 200,000 a month, including a whopping 288,000, I believe, in the most recent month, which is one of the highest readings we've gotten in a long, long time. Unemployment has fallen to 6.1%, which is well below that sort of 6.5% to 7% range that Ben Bernanke was originally talking about as kind of a trigger for potential policy changes. On top of that, the all-in unemployment rate that includes discouraged workers, part-timers who want full-time, and so on, that fell to just around 12% in June, which is the lowest since 2008. The JOLTS report showed the most job openings in 7 years in June, and the quits rate at the highest in 6 years. Basically, people are confident enough in their ability to find new jobs that they're quitting their lousy existing ones. So you look at it across the board, the news suggests that things are in pretty decent shape from an economic standpoint. So I think we're close to another case where Janet Yellen can say whatever she wants. But the bond market, again, if you focus just on the long bond, you're missing what else is going on out there. And the shorter end of the yield curve is continuing to indicate that Fed hikes are coming sooner rather than later. So that's all I've got.
Thanks, Mike. Let's see, Don Lusick, you've been talking a little bit recently about how we might see some more volatility as second quarter earnings season gets underway, as it did this week. But you've also noticed some strengthening in the Weiss ratings. So what do you see the market doing here as we move through earnings season?
Yeah, strengthening. I wouldn't call it strengthening yet. What I'm seeing is it looks like the completion of a bottoming cycle in the Weiss ratings set. In terms of bullishness, so that's more precisely what I've been seeing, and I do expect it to come back a bit here because we're in a very important earnings season. Second quarter earnings are typically pretty important as far as setting expectations for the second half. The guys talk about the bond rates, and Mike Lassen has talked about in the past of there have been a lot of positive influences on bond alternatives, such as those in the utility sector. Those returns have been in part based on this externality of the QE. Right, so we know QE is going to end in October. What we don't know is when rates are expected to go up. Now, if we get a notion during the second half that inflation is starting to heat up, I think that may be your change in sentiment towards sooner rather than later raising, and that could be some sort of trigger for some sort of market pullback. Frankly, I think that inflation looks pretty tame still. I don't think that the Fed is too worried about it. I'm not that worried about it at this point. In fact, I think that you do want to see a bit of above trend inflation, because the key statistic or the key factor that you've been looking at in the fundamentals of companies has been sloggy revenue growth, and a little inflation can go a long way in helping that revenue growth along. And so, what I'm looking at right here is I am looking at some, I am anticipating some strengthening in the Weiss ratings. We're looking for 4.5, 4.6, I think, earnings growth year over year in the second quarter. That started out the quarter April 1st, analysts were thinking closer to 5%, and now they're down to 4.6. That's not that bad. And I think that as long as companies can, reassure that that earnings growth is still, relatively robust, and that we have a reasonable expectation that the overall economy is still growing, global growth is still on the table. The kicker would be just a whiff of inflation. That might scare people in the short term, but that will actually turn out to be positive for company fundamentals, I think. Right now, I like to talk about sectors. We're looking at, energy is going to have allegedly the most growth of all the sectors in the quarter, and financials are going to have the worst. I think financials are down year over year. I don't have the number in front of me, but they should be down year over year. Now, that said, you can make the colloquialism that it's energy's game to lose and it's financials' game to win. In terms of earnings reporting and forward guidance, and I do call it a game, and I'm not trying to be cheeky about that. I think that that companies do pay very close attention to how they're doing and how the market is perceiving that they'll do in the future. I still think that it's that what you should be doing is have yourself a nice basis in some defensive stocks just in case you're wrong, but it looks to me that we're still on the mend. It's been a painfully slow recovery. It's probably going to remain sort of a painfully slow recovery. But who knows? We may get some positive indications from companies this year. In this quarter especially, and what to expect for the rest of the year and into 2015. Doug mentioned tech. Tech, as usual with the Weiss ratings, tech has been very volatile in terms of ratings. The sector has pulled back. I tend to agree that by the numbers, whoever it was, Goldman or Morgan Stanley, whoever it was that called it the most undervalued sector in the market, I tend to agree with that, and we will. We're going to get some blue chip stuff this week. Tonight is Intel, which I think is going to be a really big one. We own it in the ratings portfolio, and so obviously I'll be watching it very closely. Google and Yahoo as well, for those tech firms who are actually doing something useful with the technology that's available. But at the base, you have these chip makers, chip equipment manufacturers that will be affected by an Intel tonight. The Intel should also cast some light on what they feel PC shipment and PC growth should be, because that's been just a nightmare the past few years. Not nightmare, I'm overstating it a little bit, but we saw some indications back in May that the PC market was on the mend, especially at the corporate PC sales. Individual PC sales are still kind of punk, but I can't get too negative about this market. Obviously, it's going up. Are there externalities in play here and anomalies that we don't usually see in past cycles and non-textbook stuff? Yes, and that's really attributable to QE, to the necessity, if you will, of investors to move into the equity markets, into bond alternatives and such, as we wait for some sort of real recovery in bond interest rates. Maybe we'll get some information on that. Currently, I don't think it's going to be a sooner rather than later scenario. I think that the Fed is going to let it run a little bit. I think the Fed is going to let the inflation get a little bit hot before they act. So I think that substitution won't occur just yet, but you should expect that substitution. So if there are investors who've moved from the bond market into bond alternatives in the equity market, you should expect them to start exiting, roughly 6 to 9 months before they believe rates are going to start climbing. And I don't see that just yet. Maybe second quarter earnings will change my view on that, but so far so good with earnings.
Okay, we'll keep a close eye on earnings season as it rolls along. Thanks for your comments, Don. Bill Hall, let's go to you. Don mentioned the fact that we've seen sort of a disconnect here between the economy, the slow growth, sluggish economy, and of course new all-time highs in the S&P, which is up now nearly 200% off the 2008 lows. That's a factor you've pointed out as well, this kind of uniquely unusual times that we're in. Why don't you give us your comments?
Well, I think in the short run, I think I have to agree with the mainstream consensus out there that this market's going up. That always worries me because in the markets the consensus is always proven wrong over time. But I think for right now we're going up. I think we've seen we've seen good and strong earnings out of the financial sector, and the financials tend to be a leading indicator. Short term, I believe that I'm not as concerned about deflation as I was 2 months ago, so I think we have some inflationary forces in the economy. I think the lack of any real wage increases is troublesome, but those may be on the horizon. We'll see. So I think in the short run, again, the market goes up. I think the only reason, I'll say this and emphasize it, that the market continues to go higher is there's no other place to put money, and people need returns, and we've been talking about the market being overvalued, or not we have, but a lot of people have been talking about the market being overvalued for the last 3 years. And I think a lot of investors are just throwing in the towel, saying there's no other place I can make money. I might as well put it in the market. The market was up 32% last year. It's up almost 8% this year. Earnings growth in both those years has only been 5%. So we had 5% earnings growth last year. Consensus earnings growth this year is 5%. Yet market went up 32% last year, and Goldman Sachs came out yesterday and said they expect the market to turn in 14 to 15% for this year on 5% earnings growth. So the only reason the market's going up and with that type of earnings growth, because the equation is simple, it's multiple times earnings equals market price, is that people are just willing to pay more and more for stocks. But that will end at some point, but I don't think we're there yet.
Certainly that's unsustainable valuation increase without real organic bottom line growth, and we haven't really seen that. So we'll see if maybe this earnings season will change it. All right, thanks for your comments. Mandeep, I know that you follow stocks more from a bottoms-up approach, one story at a time rather than the macro views we've heard expressed. What are you seeing in some of the individual small cap or lower price stocks that you own in your portfolio?
Hey, good morning, Mike. Good morning, everyone. Yeah, that's right, Mike. I do, obviously the small stocks their leverage to the sentiment of the overall economy. So all of that definitely has an impact here. The Russell year to date, you just heard Bill Hall talking about the S&P was up about 8%. The Russell's been flat. It's just on the zero line as we speak. It's been a tougher environment. You're not seeing the risk on as you did last year in 2013 with the Russell outperforming the S&P's 32% increase. But we're still seeing the markets rallying a little bit higher this morning. We are a little bit concerned. We've got 30-plus months of no correction in the S&P. Usually you go about 18 months before you get a 10% correction. Valuations, as Larry was saying, are sort of stretched for the S&P. You're at 18 times trailing 12 months versus 15.5 times average. Forward 16.7 times. It's kind of stretched. And you're one of the anecdotal indicators that we're seeing and we're kind of looking at is the M&A activity. You see, every day you get a new deal that's being, some companies buying another company with their stock, with the currency, using the stock price as currency, using the cash that they had on their balance sheet. They're not investing as much organically internally. They're finding, buying other companies to get that rapid expansion, to get the exposure, getting the global expansion quicker. That's reminiscent of 2007 levels. It's not a precise indicator. It doesn't mean that we're due for a correction. We still have zero interest rate policy, ZIRP. You have economic growth, but we do see inflation picking up, which can coincide with growth, and it does coincide with growth. And we have a tighter job market, right? As Mike was saying, and that could help for wage growth, which leads to spending. Hopefully that the consumer is the largest component of GDP. Yet retail sales increasing. This morning's numbers were okay. So generally, we have growth, but we also need to say, much of the guys already talked about this on the phone call. We're looking for earnings season to propel us higher. We've seen the multiple expansion. You've seen the PE. The P has increased. The E hasn't increased as much. So you need to get the E to increase as well to sustain a market that's stretched further away from fundamentals. So if we can get that earnings growth, the complacency in the markets, just trending higher, would probably continue. The current earnings season, as Don was mentioning, banks have been are down year-over-year growth in terms of sales growth. Interestingly, we've gotten some favorable numbers. Citigroup beat, J.P. Morgan beat, but all of those companies outside of Comerica, which actually beat on the top and bottom line, all have had negative revenue growth. So they're beating lower expectations. You're getting a nod because of the low rate environment, which is impacting the net interest margins, and you have a tough regulatory environment. But with rate hikes, in the near future, maybe in the next 12 months or so, that could be favorable for banks as it causes that margin to expand, and hopefully you get that top line to increase as well. And as Bill was saying, we want to see financials participate. Last week was a little bit tough because of the news out of Portugal with the solvency of the bank there. But the recent price action has been positive. J.P. Morgan, Citigroup, Goldman Sachs beating this morning, which is positive. They actually beat on the top and the bottom line, so it was a nice win for Goldman Sachs. And we'll see if that continues into the rest of the diversified financials and the banks. If the Fed stays dovish, markets can continue higher. We'd like to see that corporate sector growth. It's still very, very early in earnings season. We have about 30 companies out of the S&P 500 already reported. You don't have energy reporting yet. That's going to be, as Don was saying, that's going to be one of the big ones that we're looking for revenue and earnings expansion on. Utilities haven't reported, no telecoms, but right now we've seen 4.5% sales growth. You're still seeing the dichotomy. The earnings are increasing faster so far in the small sample set that we've had. 7% earnings growth there. Outside of low probability events, that I think the exogenous events with one-time things like the Greece bond defaults and things like that, I think the markets are going to continue to trend higher. But there is risk of those types of events happening. And Mike, as you know, we discussed this. We bought into a low-price, undervalued gold miner this week. I'm not trying to play out the short-term volatility in gold. I just think that cyclically, the commodity is depressed. You have inflation risks on the rise. You have geopolitical on the rise. So we took an entry to get some exposure in the miners to the commodity, and so far that's been worked out pretty well for us. As Don was saying, and I believe it was Doug, tech is also looking good for us. We like the chip makers. We couldn't buy Intel because of its higher stock price. We're in the sub-10 universe. We have AMD, and they're getting some of the executives there were looking to diversify that building away from that PC chips business, so that they've been investing in the game consoles, the graphics chips, the server chips. But if we, the Intel call today is going to be very indicative. If we get PC growth in the chips there, especially for the business customers, that's going to be bullish for AMD as well, which reports later on this week. So we'll see if both can beat on that. Other than that, I think it's a cautious environment. We're still stretched in terms of fundamentals. It's a bit of a trader's environment until we get that fundamental earnings to pick up as well. And so we're staying cautious, and we don't want to be short this because the complacency can continue, and we want to have exposure to equities.
All right. Well, thanks for those comments, Mandeep. We'll certainly be keenly watching earnings season as it rolls along. Well, that wraps things up for this week's Squawk Call. Great insights, gentlemen. Thank you very much. And, of course, be sure to tune in again next week, same time. Until then, I'm Mike Bernick from Money and Markets. Good investing.